un peu de café
Non.
et du,
Une seconde.
de la crème pomme de terre.
Wait, let me.
Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is the 9th of October, 10:30 UAE time, and we have Brent crude oil trading a little bit up this morning, but still stuck below that $78 on Brent. We've come off significantly from the 80 plus close earlier in the week, and now sitting away from that height as sort of the world waiting for Godot on the next moves on the geopolitical crisis in the Middle East. Meanwhile, we sort of have to think about, the fundamentals of things, if one can do so at times like this. Let's kick off with Kate Durian, Mies contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. Kate, your reading of the oil markets at the moment, clearly in the last week, literally the last 7 days, the oil market jumped from stuck in near 70 to trying to, up to 80 and back again. Is that it from the geopolitical premium now? That's done, dusted, risk over?
I don't think in this kind of market, you're not looking at fundamentals, you're looking at market psychology, you're looking at, anticipation. I don't think there's going to be a sell-off. So I think this is where the market will probably, until the next headline. So, the fundamentals are pretty weak. You've got weak demand, you've got, the overproduction. The market hasn't really absorbed the overproduction. The Mies calculation is that in the over the first 8 months of 2024, there was overproduction by 96 million barrels. So, I mean, that's a huge chunk. So, I think it's
So those,
really
if you
difficult to
like,
predict.
violating, not complying with their
Yeah,
cuts.
not complying with their cuts, despite the fact that you have had disruptions from other countries. You've had disruptions from Libya. You've got countries under sanctions. So it's very difficult to see how you can balance these markets. And if you're looking at fundamentals, they're weak. But then there's the psychology. There's also the risk premium. I don't think, I think the market is just sitting and waiting, as you say, waiting for Godot, waiting. It's certain that from everything we've had, Israel is going to retaliate. How it retaliates, what it strikes, even if they strike oil installations, Hargal and whatever, you're talking about 1.6, 1.7 million barrels of Iranian exports. That's really a drop in the ocean. You're talking about 2% of global supplies. There's enough spare production capacity to make up for it, assuming you can get it to markets. So I think it's a very uncertain place. You look at the EIA short-term outlook, they've reduced their Brent forecast for this year and for next, not by much, but and they with the proviso that if something else happens in the meantime, then all these forecasts are up in the air.
Let's welcome Serena Huang, head of APAC analysis for Vortexa. Serena, the other big story in the oil markets, or in any market for that matter, in recent weeks has been China's stimulus. That finally, speaking of the analogy of waiting for Godot, we've been waiting a long time for the China bazooka stimulus. Has it arrived now? It seems to be petering out. Your thoughts on the China stimulus that came, and its legacy?
Yeah, thanks for having me back on the show. Truly, the market is reflecting the sentiments very closely. They were really anticipating and hoping for a series of stimulus from the government. Yes, the government has delivered some stimulus, but it probably hasn't been as big as what the market is looking for to be confident of a sustainable recovery. Now, what we're seeing from a China crude demand perspective is that refinery runs are running at 15.3 million barrels per day as of September, and this is still 5% lower as compared to the same month last year. And where we think is missing the target is especially on domestic demand. I think after the recent round of government stimulus, there has been, a boost in terms of consumer sentiments, but unless we see this translated in terms of an increase in jobs, increase in income, that kind of sustainability remains very much in question. But also bearing in mind that for the Chinese refiners, they have limited clean product export quotas, which means that they would have to be very cautious not to be overproducing. So I think the market still continues to wait for greater stimulus. The government remains pretty much hesitant to announce something very concrete and firm, and we probably still need to do a wait and see. But in the short term, we do not expect to see a short or sharp growth on the upside. Trend-wise, demand remains very much in line with the seasonal trend.
Let's welcome back to the table Daniel Richards, MENA economist, Emirates MBD. Daniel, I just wanted to sort of start with getting your overarching fiscal assessment of the Gulf states in this now going into the fourth quarter, before sort of looking at what kind of impact they could absorb from a further regional instability. But it is a year in which the oil price is down on average around, I think, still around $80 on the average price this year. We've seen cutbacks in fiscal deficits in Saudi. Where's the regional picture at the moment, and the health of the local economies of the Gulf states who are producing all of this oil for the world?
Yeah, so for the GCC, obviously it depends how well they have managed to diversify their income streams, so revenue streams, away from that reliance on hydrocarbons. So we just recently revised down our 2025 average oil price forecast quite markedly to $73 a barrel. That is on the fundamentals outlook. Obviously, if we have more of these risk premia added through the year, then there's upside to that. But fundamentally, as our two colleagues have said here, things are looking pretty weak. So in terms of what that means for GCC, we see a wider weighted average deficit next year by about 2 basis points in total, spread unevenly throughout. So biggest impact, of course, for Kuwait, still getting around 80%, I think, of revenues from hydrocarbons. Saudi Arabia have also seen a big revision to our budget deficit forecast for next year. We see it now around 5.5%, 6%. They came out with a pre-budget report for 2025 last week, I think it was. They see it at 2.3%. That's essentially on no increase in spending. They've budgeted essentially the same amount of spending next year. We think that's pretty unlikely. Maybe there will be some retrenchment. We've seen headlines in several months around some of those big mega giga projects being scaled back or timelines pushed out. But even so, spending in Saudi Arabia does tend to come in above budget, and there are spending requirements they are committed to. They have all these big events coming up in the next several years that will necessitate high levels of spending. So we expect a much wider deficit than we previously anticipated on the back of this downwards revision. For UAE, things a bit more positive. We still see a surplus next year, actually around 2% of GDP, but that is also revised down, of course, on the back of these lower oil prices. So kind of depends throughout the region. Some are looking stronger than others, but generally next year we expect pressures to be greater.
Hey, if we look at the sort of, looking through the fundamentals, I mean, and I know, as I say, it's difficult to do that at the moment because there's so many ifs on the list of things that one would have to work through to get to an outcome. But ultimately, it is the moving into the second week of October. OPEC Plus are due to raise their supply, increase their supply from December 1st, which is 7 weeks from now. Your thoughts on where the OPEC decision sort of lands if one could sort of park aside the current elevated geopolitical stress, I mean, which is now a week old, but a month ago, OPEC Plus decided to postpone the increase in supply. We've had a few reporting articles, the FT and others, saying that, you know, that this would be on the cards, and maybe even more dramatically so, to punish all of those cheating that you mentioned in your earlier point. Where do you think that OPEC Plus decision is at this point?
I mean, I think we've seen them. We've heard Prince Abdulaziz bin Salman, the Saudi minister, saying, you know, if market conditions allow, right? So, you know, they would tailor the decision. So they have already postponed it. At the moment, the price is artificially high. You know, it should be a bit lower because we saw it sink below 70 at one point. And that was really more fundamentals, right? Because we hadn't seen any supply disruptions. We've seen, you know, despite what's happening in the Red Sea, the market's managed, you know, diverting cargoes and so on. And, you know, you've got to think about refinery maintenance. You've got, you know, we're trading December, the year is out, you know, so I think if anything, if market fundamentals don't improve dramatically, then I think they won't be able to put that. It's not very much oil that's coming on the market, but at the time they made the decision, you had uncertainty in Libya, you had you know, the situation hadn't escalated to this point. So I think if the price falls, it's going to be very difficult to, you know, to put more barrels on the market that nobody wants. I mean, don't forget the US is producing at record levels. It might go up a bit more next year. So there's very little room. If you look at the call on OPEC oil and the difference between what OPEC anticipates, because they've got a much higher demand forecast than the IEA or the EIA do. So it's you might even see a cut. But don't forget, in the middle of all this, you've got the US election in a few weeks' time. So, you know, should prices go higher, it allows OPEC to put more oil on the market, but it might also penalize the incumbent Democrat Party. So it's a very, very difficult time to be sort of thinking about where OPEC goes from now. But if, you know, take out the premium, take out the risk premium, the fundamentals don't really point to the need for more oil. You've got non-OPEC plus countries, you know, you've got Guyana, you've got Brazil, you've got oil coming from non-OPEC. So the room for maneuver by the OPEC Plus is very, very narrow. It's very limited.
Serena, the question of China imports is sort of the critical question for the markets. And we've seen that being somewhat sluggish this year, generally flat and the overarching growth in Chinese demand growth. But in terms of imports, we did see a recovery in August. It seemed price opportunistic. What does it look like now? Obviously, Vortexa has the great advantage of being able to look through the looking glass, if you like, into the shipping lanes where the tankers are moving. And what does it tell us about the volumes that China continues to import?
Yeah, indeed, we did see some sort of a recovery this quarter, but I'd say that the levels of imports, seaborne imports, remains below the 10 million barrels per day mark. There are a couple of refiners who have been drawing down on their inventories, but that drawdown seems to have slowed in the more recent weeks. But going forward, what we see was that Q3 is the seasonal strength of the Chinese oil demand, where construction activities, agriculture, fishing has been very much seasonally the highest in the year. And going into Q4, we expect this demand to actually slow down. And coupled with the fact that oil prices are actually rising, it is really not a good kind of environment for the Chinese refiners to pick up more crude. Now, there has been talks that the government has mandated an additional 8 million tons of crude to be stored to increase the SPRs, but we need to know that this is actually a soft mandate. There isn't a real need for state-run refiners to do so. The timing actually matters. I do not think that they are very much incentivized right now to pick up more crude. So I think from that perspective, we do not see an immediate increase in crude imports. And when we look at freight rates as well, the benchmark TD3C Middle East Gulf to China, VLCC freight rates have remained relatively sluggish despite some form of a week-on-week increase over the last week. So that tells us that we continue to expect minimum growth in terms of Chinese crude imports going forward.
Daniel, looking at the regional economies and the impact of such a scale of geopolitical stress in the region, all in all, we've seen this year and in the last year of this current period of stress in the geopolitical picture in the Middle East, that the Gulf economies have been fairly immune. They've continued to perform well. Tourism has continued to move in big numbers here in Dubai, which is obviously the big sort of a center for entry to the region. Generally, what is the Emirates MBD outlook yet? Is there a sense of where could this go? How resilient are the Gulf economies, the tourism, the trade, to a growing stress of geopolitical fractures?
Yeah, as you say, this year they performed remarkably well despite it. And I think you could say there's been very little marked impact, especially on tourism numbers, as you say, for Dubai, record numbers in H1. I think we have figures through to the end of July now up around 8% year on year. Obviously, we don't know the counterfactual if there wasn't any disruption, but it hasn't been a material slowdown in any case. That's even despite the fact that pre-pandemic figures have now been more than eclipsed. And it's not just Dubai, you've seen stronger growth figures in tourism in Abu Dhabi as well, Bahrain, throughout the region. So really strong growth throughout. I think one material impact we have seen from a general unrest and disruption has been on shipping. Disruption to Red Sea shipping in particular has driven up input prices for businesses here. We see that reflected in the PMI surveys where firms are reporting higher costs for raw materials, higher costs for shipping in particular. They are passing that on to a greater extent now to consumers than perhaps they would do in the past. In the past, they used to try and absorb higher costs as volume growth expanded. The other big impact, though, I guess, outside of the GCC would be for Egypt, of course. We had the Suez Canal revenues for the fiscal year come out last week or earlier this week. I think it was 7-point-something billion, down from 9-point-something billion. So that is a material impact for a near neighbor in the region.
And of course, obviously has resulted in a lot of money or investment that the Gulf states have put into Egypt over that year with their vulnerability to the loss of hard currency from traffic through the Suez Canal. We had the director of planning of the Suez Canal Authority with us in our Fujairah forum last week, and he was saying that for the year 2024, you've obviously referenced the fiscal year of Egypt, but in terms of the current calendar year, he was saying that revenue is down 50%. It's down to about 5 billion will be the revenue for the year 2024. So a big impact for them, obviously, with the traffic there. Let's go to the survey question and get the view of the room on this point of OPEC Plus, trying to look through the fog of this current window of geopolitical stress and the decision that OPEC Plus the decision as it currently stands is that from the 1st of December, according to OPEC Plus announcements through the year, they will start to increase oil supply. Do you expect OPEC Plus to proceed with plans that they have announced to start to increase oil supply from December 1st? Yes or no would be the question there. Kate, looking at the scale of it's such a big word ultimately, but the cheating, but those countries not cutting to their agreement as announced. Is that of a scale? Is there any indications that that's coming into line with these sort of scares about possible, market share battles and price falls. I mean, once this window hopefully passes quickly on the current geopolitical crisis, we could see that price soften again. Do you see that the non-compliers are coming into line so that making this decision to proceed in December or not will be to be based on some fundamentals?
Oh God, I mean, I don't know about a price war because the only country that has the capacity to say, you know what, we'll flood the market. And you and I have seen it before, you know, when Saudi Arabia says, okay, you want to see $20 oil? We've got the capacity, we can flood the market. They have what, more than half of available spare production capacity in Saudi Arabia. And I mean, that's also weighing on the market. And that's one of the reasons, I guess, why the market is not responding to the potential loss of Iranian oil or, you know, disruption. The point is, of course, you've got to get it to market, and that's the big question. But I don't think Saudi Arabia can afford a price war. I mean, if you look at the latest, they've revised down their midterm expectations, and the budget deficit is going to be higher than anticipated. So I don't think they can afford it. I mean, yes, the Saudi economy is pretty solid, and you can run a deficit. But don't forget who is actually going to be financing this deficit, who's going to be financing the spending, you know, through royalties. It's Saudi Aramco, that's the cash cow. So I don't think you can afford to have a price war, and particularly not now. I mean, yes, the Saudis have in the past floated these balloons to see how the market reacts, right? And to scare people. But I think we're seeing signs that Iraq is beginning to comply with the cuts. And I suppose that 2-month extension that they gave themselves before putting back 180,000 barrels a day onto the market starting in December, which isn't a huge number, but that 2 months gives time to sort of allow these countries, mainly Kazakhstan, Iraq, and one more, I can't remember which one it was, that is overproducing, to sort of comply, to improve their compliance. So, we'll wait and see. But I think, 180,000 barrels a day isn't enough to fill up, a quarter of a tanker. So I don't think it's going to have that much impact on the balances.
But as you said at your earlier data point, which sort of caught me, it was by when you aggregate all of that daily amount into a total number. I think you said 96 million barrels
96 million.
For the course of the year to date. That obviously is a significant number. And when you think of that, maybe all going into storage or wherever, it does provide a softening cushion, a bearish sort of tone to the market. Serena, coming back to China and expectations, it's a bit like when we looked at the US coming through and out of COVID. The US consumers and economy became addicted to the stimulus that was being offered and it was waiting for the next one and the next one. And literally checks were mailed out to every citizen in the country, et cetera, et cetera. I mean, it's quite dramatic. We're still living with the scale of liquidity that the US monetary policymakers and fiscal policymakers pumped into the system. I'm wondering, from a China point of view, we've seen that, we were, as I said earlier, expecting that through the year. It wasn't coming. It seemed like the Chinese government were really resisting that sort of easing. Now they've delivered one sort of bazooka. The expectation for more is there. What do you think the appetite from the sort of fiscally prudent Chinese government will be on that?
Yeah, I think it's really hard to tell, but one thing is that the government is pretty staunch in trying to meet its GDP growth targets. That's about 5% this year and probably slightly over 4.5 to 4.7% next year. And I think the government is walking a very tight balance between meeting its GDP target, but also ensuring that this growth is of high quality, which means moving towards innovation, improvements in technology, all in the name of advancing or elevating the standards of the economy. So from an oil perspective, I think the government is also looking at at the end of the day, carbon emissions. So the government has already put out a mandate that it will keep the total refining capacity at below 20 million barrels per day by closing down the less efficient refineries. And I don't think from an oil perspective or refinery perspective, the government is doing much to stimulate and support the refinery industry, so to speak. So at least from an oil demand perspective, I think things will still take its natural course. It really very much depends on how the domestic demand is performing.
And what is the domino effect of that? I mean, just through the other parts of the region. I mean, coming into the fourth quarter is typically a sort of a rise in demand going into the winter, and China also has the added pull on with the China New Year holiday being a big holiday season in which the oil store is stored a lot for that. I mean, where do you see the rest of the region beyond China benefiting, not benefiting from China's stimulus and its own outlook for demand?
Yeah, I think the government has already set out the mandate, so to speak, and from an export quotas perspective, the additional 8 million tons that is given as a final batch of export quotas. And this is lower as compared to the market expectations. Now, to a certain extent, the rest of the region could benefit in a sense, especially the export-oriented countries like South Korea as well as Taiwan, because lesser exports from China gives them more opportunities for exports to the rest of the region. So that's definitely up for them. And for the rest of the region, from a domestic demand perspective, we expect to see, for example, India performing pretty well from a seasonal perspective. That's where the festive seasons will actually kick into place. And Southeast Asia this year has been performing very well as well. So countries like Philippines, Indonesia, as well as Vietnam, from a GDP growth perspective, they have been clocking in anywhere between 5 to 7% of year-on-year GDP growth. So I think that's really good. And from a domestic demand point of view, it's definitely supportive of oil prices.
Daniel, we're in the middle, or not the middle, I'm not quite sure what stage of it, but ultimately we're well into now the rate easing cycle that is kicked off earlier in the second quarter, and we had today the New Zealand Central Bank cut its official rate by 50 basis points, quite a significant, a bit like the US, a 50 basis point cut there. What does it look like that? What does that tell us? I mean, it's a small economy nonetheless, but some kind of bellwether for a much more aggressive cutting cycle than maybe was previously thought.
Yeah, I think New Zealand, there are quite salient concerns about growth there. I think employment is looking pretty dodgy as well. So I guess that explains the bigger cut there. But we also had this morning the RBI, where they didn't cut as had been expected, but they did adopt a more dovish tone. And Governor Das has been very hawkish to date. So I think that's as meaningful as the cut in New Zealand to confirm that we really are in a global easing cycle now. All of the majors have now embarked, save obviously the outlier, Bank of Japan, but that 50 basis point cut from the Fed last month. We don't expect another 50 going forward. We didn't even in the wake of that meeting, even as markets did, but all the same, even with that big jobs number, massive upside surprise last week, we still expect another 25 basis points at the next two meetings as well. So cutting has now started, and we expect it to continue.
And just for those of us who are still scratching our heads on the sort of rate cutting cycle, I mean, you mentioned the specifics to the New Zealand, but obviously the 10,000 pound gorilla is the US economy. This is a very healthy economy that's aggressively cutting rates. Can you square that circle?
Yeah, I think it's just that they want to be less restrictive, but it's not that they are maybe to get ahead of the curve of some weakness we had in labor market points ahead of last week. But I think over the last month, the language post that meeting, we'll see the FOMC minutes tonight as well from Powell, was that this will not be the new pace, and comments since then too. And then it wasn't just the NFP report, we also had that a series of pretty healthy initial jobless claims data, ADP data. All of these data points have been pretty strong. So we don't expect further 50 basis points, of course. We think that was just a big starting jump to start off, but we don't expect that kind of aggressive cutting to continue.
Are we in search of a new neutral rate that it's not a a reduction to stimulate, but it's a reduction to find what is a new neutral rate, the rate in which the price of money doesn't sort of incentivize, but it doesn't restrict.
Yeah, exactly. I think that's a fair assessment of the situation. And I think they're not really sure where that new neutral rate is at present, but clearly I think it's probably lower than we currently are. That said, we're not going to go back to post-GFC levels. I don't think anyone expects that even the terminal rate will be far higher than we have been used to for the past 10, 15 years.
Yeah, that certainly does seem to be the case. Well, we have to wrap it up there. We've got, as we said at the beginning, Brent crude oil trading. Well, we've got our no's here. Do you expect OPEC to proceed? No, but still a sizable yes there. So kind of 50-50 early on the outlook there. And I think obviously factors over the coming days could determine a lot about where all of this goes. Brent crude oil is trading below 80 or below $78 a barrel, up a little bit this morning, up 0.5% in Asian trade, but still at 77.50 on Brent, which is well off the highs we saw earlier in the week, above 80. So again, it's sort of a holding pattern. It feels in the high 70s, whether it's going to retreat to the low 70s because events don't turn out to be as bad as anticipated, or if they end up being a lot worse than anticipated, we could be going much higher. So we all wait for that, I think. Thank you guys so much for your participation this morning. As always, Kate Durian, no better in the business than Kate. Serena Wang, thank you so much from Vortexa in Asia. Great to have your insights there. And Daniel Richards, top economist in the region. Thank you so much, Daniel. Take care, everybody. Have a good day. Bye-bye.
Bye.